I'm curious, Sebastian, whether you see any kind of broader, deeper signs of stress in the market that would indicate to you maybe this is just kind of the start of something nastier.
Look, we could get a pullback further than what we've seen today. The economic data is decelerating, and you see this with the PMIs. And we've had a really good run in the stock market. But if I step back and I look 12 months ahead, I don't expect a recession. I think stocks will do okay. I think credit will do okay. I think the market is due for broadening. I also think AI is going to continue to boost spending and earnings. It's real. The thing I worry about is that we're pretty far from the 2% inflation target that the Fed has set for us. So we're positioned slightly long value stocks. It's not like we don't like growth stocks. It's just that we think the market will broaden towards value stocks. And that in part reflects our macro views.
And you summarized that strategy by saying, be boring,
Yeah.
which I love that framing of it. And is that what you mean by that? Sort of be slightly long value, don't expect maybe more fireworks, or don't try to position for more fireworks in the market?
Well, you know, Julie, it's my first time on your show. I wish I had a pound the table asset allocation view. But my point is, between stocks and bonds right now, you don't want to load up on risk, in my mind, but also you don't want to be completely out of the market. So I go back to thinking about your strategic asset allocation. What is your risk tolerance? And how much stocks should you own in a quote unquote normal environment? We're never in a normal environment. But right now I would just stay close to center. You know how much risk you're willing to take between stocks and bonds. Kind of stick to that. That's a little bit boring, but you know what? This is the kind of environment where growth is decelerating, but it's still pretty high by pre-pandemic standards. And earnings are actually coming up, but all of this seems priced in. The fear gauge, the VIX index, this morning had an 11 handle. So, and we've had a great run in markets.
In other words, nobody's worried.
Yeah,
That's what that 11 handle means.
Which is when you want to be a little bit more worried than usual. We tend to be contrarian. We like to lean against the wind. And so right now I would just stay in the middle.
How much, Sebastian, if sort of your outlook, your thesis, how much is it dependent on the Fed and what they do over the next 12 months? How many cuts are coming?
Look, I think the market thinks about the Fed or talks about the Fed or even reacts to the Fed way too much right now.
But it's hard, Sebastian, because they don't stop talking.
I know.
That's part of the problem, yeah.
I know, right? I'm with you. But look, we're looking at a market that I call it narrative ping pong that is sensitive to a 0.1% difference in a monthly inflation print. Why is that? Because the Fed is telling everybody they're going to be data dependent. And guess what? The month-to-month data is pretty random. There's a big unpredictable component to it. So we're on a knife's edge. But if you think about it, 25 basis points, yeah, probably rates are coming down, probably one cut over the next 6 to 12 months, maybe two. Does it really make a huge difference? We had a 550 basis points rate shock, and markets have been quite resilient thus far. So the economy and ultimately I think markets have become a bit less sensitive to the Fed, even though we're obsessed with it and we just keep talking about it. Look, in our portfolios, actually slightly short duration. So we think that there's probably upward pressures on rates due to upward pressures on inflation. Wages are still growing over 4.5%. That's not consistent with 2% inflation.
And finally, you know, I know you don't have a pound the table kind of conviction call, but is there anywhere, be boring, maybe be mostly boring, is there anywhere you think people should sort of reach for risk? Any areas?
So, believe it or not, even though credit spreads are pretty tight, the way we position the fixed income portion of our portfolio is a barbell between cash, which, by the way, because the yield curve is inverted, cash will give you 5+%. That's pretty nice. And credit, so actually long credit. So we have
like
this
investment
barbell.
grade credit?
Yeah, investment grade credit, even high yield, even emerging market debt. You diversify the credit exposures. In stocks, where we're a little bit contrarian because we've seen so much flows into growth stocks, that if you want to position for the market broadening, I would not necessarily do it with small caps. I would do it with large cap value stocks. There's a wave of AI productivity coming, and some industries that have not been touched by the magic of AI are actually going to start to get spending productivity increases and so on, and it's going to help. By the end of the year, by the way, the value stocks are expected to grow their earnings year over year faster than the growth stocks. That's because you have very easy comparables for value stocks. But there's a passing of the baton that if you look forward, not backward, because that hasn't worked so far, but if you look forward, you can expect that broadening.
Well, it turns out there's a lot of like different investment ideas in Be Boring, Sébastien.
Yeah. You know what? I'll say this. I am aggressively, convincingly neutral between stocks and bonds. I'm pounding the table to be neutral.
Okay,
Strong
fair
neutral.
enough.
Yeah.
Thank you so much for being
Thank you.
here. Really appreciate you being in studio with us.
Thanks.